And welcome everybody and happy St. Patrick's Day. I'm Brent Solomon. I am the chair for our DC, Maryland, Virginia chapter, and my valuation and transaction advisory practice is known as strategic financial advisory. Glad you could join us today. This is our first event of the year. We're going to be shooting for 6 events this year and hopefully in person and not too far down the road. We do have a large crowd today. We have 264 people registered. So that is a new record for us. And while I have your attention, please make a note or mark your calendar. Our next event will be April 21st. It will be virtual. It will be our healthcare focused event, focused on technology to improve outcomes for patients, providers, and payors. It'll be focused on success stories and opportunities for businesses and M&A professionals. And we're going to have a special presentation by Tim Souther of Change Healthcare. So I'm going to share my screen very quickly for just a couple quick remarks. All righty. Want to thank our DC chapter executive committee. Names are on the board there. And our sponsors, without them, we would not have a chapter. If by chance you are interested in sponsorship, we do have a couple open categories. We had about 27 new members. Now, as a member, you join the national organization, but we know where you live. So we count 27 new members for our local chapter last year. And what I wanted to do was put up on the board. These are our newest new members of the last 2 quarters. So welcome to our newest members. I hope some of you are out there, but with 264, we won't try to find you. Okay, now, just to let everybody know what is going to happen after the panel, which will run for about 1 hour, we have some virtual networking set up. You were also requested to bring a green drink to the networking hour, but you do not have to. Okay, and what's going to happen is you're going to be randomly assigned into a networking room, and those rooms will be shuffled. Our speakers and panelists will be in those rooms, and hopefully they can kick off the conversation. So with that, I will see you guys after the panel presentation, and my pleasure to introduce Pete Ryan of Ryan and Wetmore, who is one of our executive committee members and a sponsor, to do our moderator introduction.
Thank you, Brett. This is Pete Ryan from Ryan and Wetmore. We're a regional CPA firm with 3 offices. GovCons are our biggest niche. We specialize in it. And again, I think it's a great networking opportunity at the end of the event. So we encourage everybody to join that. You know, the breakout rooms are a big thing. And I'd like to introduce now Sharon Heaton, who's going to be our moderator for the panel. She's she works on M&A transactions from 15 to 150 million EBITDA, 2 million plus, and I'll let her, do her own introduction.
Well, thank you, Pete. It's a pleasure to be here today. And I'm just delighted, as I'm sure everybody is, with the turnout. And now it's our obligation to deliver real content and meaning to you. As Pete said, my name is Sharon Heaton. I am the founder and CEO of SB Liftoff. We're an M&A advisory firm, which is simply a pompous way of saying that we help people buy and sell companies. As Pete indicated, most of our deals are between that 15 million in enterprise value up to about 100 million. And we work very much heavily in the GovCon market. And that is a unique place. So if somebody says, oh, I can do GovCon as well, please understand GovCon is a unique animal. Rather than introduce all of my colleagues, I'm going to ask them to introduce themselves. So we're going to start off with Bob Lofeld.
Good afternoon. My name is Bob Lofeld. I am the founder, owner of Step1 Tech. I founded the company in 2010. We grew to the point where we got out of the small business arena. In 2019, we found a great private equity company, DFW Capital, decided that the best route for us to gap small to large business, now that we were competing with the billion-dollar publicly traded companies regularly, was to do a PE infusion. And since then, we've been growing ever since. What's important for you to know is I have been on both sides. I have both sold my own company and bought another one. And both sides are nerve-wracking and full of all sorts of exciting adventures. And I'm happy to share what I've learned along the way. Mark?
Hi there. I'm Mike Morehouse. Happy to be here today and meet all of you. I am sort of a serial GovCon guy. I started out in the industry in the early 80s. In 1987, I started a company with two other partners in GovCon, mostly in military in the intel world. And we ended up selling that in 2012 to Arlington Capital. So we had a nice exit to private equity. Got a chance to roll over and feel what that was like to be a part of a larger team. That was very exciting. Then I sat out for a couple of years. I did some investment banking advisory work, not represented, but was involved in a couple of buy and sell side deals. So I got a lot more inside knowledge on how the process works. And then one of my former business colleagues dragged me back into GovCon. So in 2018, we started Coreforce, and I'm the CFO and managing member of Coreforce, or managing partner. And we would be considered, or at least latter part of this year, early part of 22, will be considered a buyer, probably the best way to put it.
Terrific. Cy Alba.
Yeah, hey everybody. I'm Cy Alba. I'm a partner of the law firm of Polero Mazza. We do mostly government contracts work, and a lot of that tends to be in some of the M&A areas, helping specifically government contractors and a lot of small businesses or larger companies who are acquiring small businesses or small business contracts, sort of navigate that area. So as for this presentation, that's basically what I'm going to be touching on and dealing with here. So thank you, everyone.
Terrific. So those are our panelists for today. And let me set the table a little bit. We are talking about market perceptions and strategies for owners of GovCon companies that have set-asides. When I went to an event a year or two ago, and there was an investment banker who stood up in front of a crowd of about 100 people and said, if you've got a set-aside company, it's really not transferable. You know, basically work on the company, get the revenue and the profits that you can while you own it, but recognize it's a lifestyle company, you won't be able to transfer it. And I found myself jumping on the table and saying, that's not true. There are definitely some concerns, and there's definitely some companies that aren't transferable, but there are many companies that have set-asides that are transferable. And in fact, in today's market, that's getting a little bit, it's getting a little bit easier to transfer them. So we want to start off with some of the questions that we actually put on the pamphlet when we said, this is what we're going to be talking about. The first one is the myriad of reasons buyers are acquisitive and what they're looking for today. I'd like to start that conversation off focusing on Bob, and then I'm going to throw it over to Michael, because they are people who've actually been buyers and sellers. So Bob, can you tell us what you think buyers are looking for today?
Absolutely. And I want to thank everyone who joined us today, because I wish I would have done this earlier in the life cycle of my company. I figured it all out about a year before I needed to do it. So the bottom line is the market has what I consider 4 different types of buyers. There's PE, private equity, minority stake buyers that will buy less than 50% of your company. You still have control, but they provide guidance to help you nudge along the way. The second are platforms like myself. Sev1 Tech is now a platform company in the market, and we're active as a buyer. Platforms have a different buying characteristic than PEs that do minority stakes. PEs that do majority stakes are looking to create platforms like myself. Take really good management teams and pull more bulk into the company and add more capability. And last are the strategics, which for us, graduating from small business, are both larger mid-tier companies, as well as the billion-dollar traded. So the first thing that I always like to think about is who's the buyer? If it's a minority stake, right, what they're looking for is a good management team that they can see grow into large business. If it's a private equity that's looking for a majority stake, they're looking for a small business that already has some large business in the portfolio, and they believe that the management team can scale to make the journey to a large business. From a strategic perspective, usually those buyers are looking for capabilities. So for example, if you're a $50 million company and you have $5 million a year and 10 different customers, you're not even going to be a blip on those different stakeholders that would need to be buy champions for a deal. So depending on who you're looking at, it changes. Even within platforms like myself, some platforms are looking for scale in a particular customer. So let's say today you have a great health IT business, right? And let's say it's maybe around $30 million a year, $40 million a year run rate. That could be very attractive to a platform that wants to break into health. There are other platforms that really want a capability, right? We want to, for example, if you want to get into Agile, right? And you're a platform, you have a great infrastructure history, you don't have Agile, right? You might look at a software company that's 30 to 40 million. So don't think of the market as one type of buyer. Think of your company as what are you trying to position for? I think the other thing that's important, and it takes a lot of self-awareness, is when you cross that small business threshold, what are you really selling, right? Are you selling a management team that you believe can operate a $300 to $400 million company? Are you selling a capability that would come into a company and infuse a new talent or methodology that they can put across their client base? Or are you selling access and intimacy with a very attractive client? There are different platforms even looking for different capabilities and different customers in different sizes to fill needs within their platform. The one thing that I would say is it is an extremely active market right now. As a buyer, it's not untypical to see 8 to 10 companies, sometimes north of 10, 15 companies competing for a company coming to market. Platforms like myself, look, I was a small business. I started out with 3 gals and a shingle, and now we're a big company. But those days are still burned in my brain. There is value there. When we sold Sev1 Tech, or when I did my PE deal with DFW Capital, we still had 30% small business in our portfolio, 35%. But what we had shown was a pathway to get to large. So if you have 50% small business, there may still be a buyer out there, but you have to be realistic about the value of that portfolio. The large business revenue that is sustainable and you can win recompetes in full and open, right, are really what gets you value as a small business. You can't be what I call the whole transaction process unintentionally offensive, right? When someone says, well, this I'm not going to be able to do anything with in 2 years when it recompetes, it's going to be a sub position. So I'm going to cut the revenue, cut the profit, and use that as my run rate going forward to build my model for value. So it's a very interesting process, but don't think because you have small business in your portfolio that there isn't a fit out for you there in the market. The market is very aggressive. There are more platforms now in the business than there have ever been. Last time I checked, there were 69 of us that are all in with private equity that are doing different types of, not only acquisition, but a lot of organic growth. And that's one thing that's very important. The right time to bring your company to market as a small is when you can demonstrate organic growth, right? Can you win? Have you invested in your company not to win a set aside? Because at the end of the day, winning a set aside is easier than winning a full and open. Have you invested to win full and open? And do you have a track record to do that? The more you do that, the more value in your enterprise. So Sharon, to answer your question, it is a hot market. It's no longer what I would consider, single vision buyers out there. And there's a lot of folks looking for different things, whether it's a private equity, a platform, a strategic, or bolt-on. It's a very active market. You're on mute.
Excellent point. Thank you, Bob. Mike, how about you?
Yeah, that was great, Bob. Very, very comprehensive. And I only have a few more things to add and probably a little more focused on the kinds of things that I'm up to as a buyer. So when I saw this question, it was obviously two parts to it. Why are buyers acquisitive? I think, I think the market's been very, very strong for a number of years. But when you look at, the availability of capital, the investors out there that are willing to step in when there's not, well, I would say this is a safe bet in our market area. So you've got a wide range of investment capital. You've got low interest rates. You've got banking partners that are going to help you, get your deals closed. So that, that all just helps fuel that demand from the buyer's perspective, certainly from ours. And it's very encouraging. What are we looking for today? So we're on a path to accelerate our growth. It's plain and simple. We're trying to fill both large strategic gaps and smaller gaps in our vision, if you will. But we want to do that rapidly. We're not looking to do this over a multi-decade period. We're being very aggressive in our plans. So what we look for is companies that are in specialized markets that are typically high barriers to entry. That creates a lot of value. Those negotiations can be very interesting. It's companies that have solid client relationships. That's a huge thing for us when we go in and do not due diligence, but actually sort of weigh a company, whether or not we want to move down a road with them. It's that client relationship is really important to us and how far that relationship will carry. Then, of course, specialized capabilities, IP, things that are making a difference in the market. It doesn't have to be necessarily, quote, commercial products, but if you've got solutions that clients are leaning on or depend on, that has real value. It certainly has real value to us, and I know other buyers are in the same boat. So.
Terrific. Sai, you're on mute.
Yeah, so I think the only thing I'd add is maybe the flip side of what I see people do that you probably can't, or you need to be careful with, is sort of buying in thinking, oh, well, these guys have some dead IDIQ that's really big, and I'm just going to buy that and use that to jumpstart and really grow my company. And especially like GSA and agencies like that are really cracking down on the Anti-Assignment Act, which unbelievably actually prohibits the buying and selling of federal contracts, which I think people sometimes say it happens all the time. But there is an act that prohibits that. You have to sell assets with it. And GSA is getting wise to certain things. So kind of be careful there. And also the idea of buying past performance from essentially dead contracts that you can get really inexpensively. The case on that is very bad. So if you're buying an entire company, fine, you can be the successor in interest and get all that past performance. Whereas if you're just buying like little assets you think you can get dirt cheap, or people going bankrupt or whatever, it's more difficult. So I see that a lot and have to kind of walk people back or strategize about how to do it. So just realize those are sort of pitfalls.
Excellent points. I wanted to, at SB Liftoff, we see both. We see the companies like Bob and Mike, where they're talking about companies that are almost adolescents. They've been operating for a while. They're making the move into full and open. They haven't fully gotten there yet, but they're trying to sell into the full and open market. That is clearly one path. At SB Liftoff, we actually see a lot of companies that are truly staying in the set-aside market. And there are more complications to staying in there. And as Bob indicated, the values are definitely going to be less than they would be for a full and open contract. But things like backlog, past performance, customer intimacy are going to be incredibly important regardless of where you are in your life cycle. In order to keep us moving, I'd like to talk a little bit about the next issue, which is the state of the capital markets. Bob, I think that you made some reference to that. I'm going to kick it to you in just a moment. But again, I want to talk about the differences between the two different markets that are going on. If you are in a world where PE might be interested, you're mostly full and open, there's not too many set-asides, et cetera, or your EBITDA is over, let's say, $7-10 million, then there are banks who are going to be interested in helping you with that acquisition financing, and there certainly will be PE that's interested. If, however, your EBITDA is lower, then you're really not going to be talking about the commercial bank market. They're much more hesitant to lend for acquisition financing that's not backed by accounts receivable or some type of asset that they can do as an asset-based lending. So there's definitely some gaps in the market for smaller companies. But Bob, I think that you're pretty active in the larger size. Why don't you tell us what you think is going on in the market right now for deal structure?
Yeah, and Sharon, you hit a chord, because I still remember when my business plan said we were going to do 300K the first year and we did $1 million, and I was trying to figure out how to finance payroll. And every bank I talked to is like, well, you've only been in business a year. We can give you a home equity loan. And I'm like, well, my house is worth nothing. That's not going to make payroll. So banking is extremely important. And while the capital market comes into it later, I cannot stress how much out of the gate having a good banking relationship with someone familiar with GovCon that can scale you across is key to your strategy 5 to 10 years out. I was blessed to meet Mike Grady from Atlantic Union. He's been with me since 3 people all the way up to 650, which is where we are now. And they've always been a partner. So having a relationship where the bank understands your business over time and whether or not you've performed, it's all based on your credibility of hitting your plans, right? Makes a huge difference. In the PE market, it's not a secret. There's a lot of PEs out there that have raised a lot of capital. And they've got to do something with it because their investors aren't giving it to them to set it in a 1%, money market account. They've got to put it to work. So the one thing about the PE market is they are constantly looking at how do they create value, and that value usually comes with scaling companies. The second point that I would make is the banks start to get interested in you when your run rate's up over that 10, 15 million, and you can do bank deals. Now, for most of us as smalls, they're not going to come in and finance your whole deal. Maybe they will, maybe they won't. It depends on where you are in your life cycle. If you're at 10 million revenue trying to get to 20, maybe you can get some financing for some investment, but your company really has no value other than receivables. And you want to try to avoid stuff like factoring that, takes you down a profit rat hole. It's hard to get. I can still remember we were $31 million when our debt was $30 million when my personal property wasn't tied to the debt of the company. Like I've been in business for 6, 7 years. I'm like, we're here to stay. So get a good advisor early, get a banker who's proven they can scale in GovCon, and get the best deal all the way throughout the life cycle. But the problem out in the market, in my opinion, is not getting capital. It's getting really good, clean businesses, right, that you can target to integrate into your company, regardless of what type of buyer you are. It's finding really good companies because good assets will always get a premium regardless of the market. But right now, all of that pressure is raising multiples, even on the small business discounts. They're not discounting as heavy as they used to. And all that money flowing in definitely makes it a seller's market. Because at least from everything I've seen and probably the 70 companies I've evaluated, there's a lot of pressure even for bad assets. So,
Mike, what's your thoughts on bad assets?
I stay away from them.
But good for you.
So a couple of comments, and I made a few on the last question. I mentioned that the capital markets are pretty strong. I think Bob's reiterating that. The bankers are obviously following all their process, but I think eager to lend to good companies. And at the risk of embarrassing Mike, because I see him on the screen, Mike's our banker as well. We just gotten to know Mike over the last year, but he's been fabulous with us, and we look at AUB as a long-term partner in our strategy. A couple of things I would say on the banking side, and this is really more as a seller. If you're going into a deal, we've got a couple of things out there that are not obstacles, but things to think about. So if you did take a PPP loan, and many of us did, there, there are implications to that during a deal. The SBA has mandated certain provisions that have to go into any term sheet with escrows, and I'm not exactly sure what other buyers are doing, but I would expect your banks to be looking at that hard, or the buyers' banks to be looking at the balance sheets of the sellers when it comes to those PPP loans and whatever that might come out of those. So just keep that in the back of your head, that will be something you'll have to go through as a seller. The other thing I would bring up, and I've heard this come up in my conversations, and it's mainly viewed in a derogatory sense, and I don't really view this way. But when you get to the table with a buyer, and a lot of times private equity will do this, they're going to offer you what they call a second bite at the apple, right? We've heard that term a million times. A lot of people raise their eyes, roll their eyes on it. Oh yeah, right. That just means you're not going to give me all the cash. But I would absolutely take that to heart and consider it. I've personally had 2 rolls, if you will, on bites, and they've both been successful. They're, private equity, they're masters at what they do. And if they're going to offer you a ticket to ride on the second train, you should consider it. That's all I'm saying. I think that you could have some pretty good outcomes. But I would expect that when you go to sell, you might hear that if it's a private equity firm. You might even hear it from a strategic. I'm not sure, how the strategics set theirs up, but certainly maybe the mid-market strategics. But that's all I have to say on the topic.
Let me respond to that just a little bit. The PPP loans are definitely an issue. Obviously something that none of us had thought about a year and a half ago. And now as I'm doing deals, they constantly are coming up. I had a situation recently where we are basically in the market talking to buyers. And as we're getting ready for the LOI, I find out that my client, who'd already gotten a PPP loan before and was in the process of forgiveness, applied for a second one and was approved. Now, this was a very interesting situation because in order to close a deal with a PPP loan, you basically either need to have gotten forgiveness for it, or you need to escrow the entire amount just in case, in fact, it's not forgiven. It was easy to figure out what to do with the first loan because it was forgiven, no problem. The second one was by the time that we closed this deal, most of that new PPP loan would not have been spent. So that means that the seller would be counting on the buyer to use that money appropriately so that loan forgiveness could be achieved for the benefit of the seller, not the buyer. That is a difficult position to be in. And I think that the seller is going to choose to return the money because they were not going to be using it themselves since they're going to be selling the company, and they would have all the risk and really none of the upside. So PPP loans are something that absolutely need to be considered very carefully. Want to move on to the issue.
Hey, Sharon, can I just mention one thing that Mike brought up, the whole second bite of the apple for owners?
Yeah, absolutely.
I think that what's one of the things we don't talk about in this process is your decision sends signals to the buyer. So when I was selling my company, I'm only 49. I got another 10, 15 years in me. I wanted my buyer to know that I wanted to have a large stake in the future of the company, and I wanted my management team to have a stake in the future of the company. So for me, rollover equity is what they called, was very important, right? Because if I'm going to stay as CEO, what message do I send of say, hey, buy my company, my management team and I, we're on board, but we don't want to keep any stock in the new company, right? I mean, they're going to run for the hills. So that messaging and what I call an entrepreneur's nexit, what's their next venture, whether it be a rollover, whether it be move somewhere where they grew up, right? Your messaging and the way you structure the sale sends signals to the buyer. So
Bob, an incredibly important point, and let's talk about that just for a moment. Sellers are always nervous as they're getting ready to bring their company to market. They're nervous about whether or not people are going to find out, their employees, competitors, clients. They're nervous, are they going to get treated fairly in the process? Will they get full value for their company? As nervous as sellers are, buyers are even more nervous.
Yep.
Because no matter how much due diligence that buyer does, on the day of closing, the seller will know more about the company than the buyer does. So the buyer is kind of looking over their shoulder at the seller to say, does the seller know something? Do they know about a problem that I'm not discovering? And I'm going to be stepping into their shoes and they're going to be stepping out. So it's very important that sellers exhibit confidence in the companies that they're selling. And they can do that in a variety of ways. A second bite at the apple, some equity rollover makes a lot of sense. So there are ways to be communicating that. And it really goes to building trust between the buyer and the seller. You can't say as a seller, I absolutely love my company, but I want nothing to do with it in the future, because that really kind of undermines that message. Bob, does that sound about right?
Absolutely. And the follow-on to that I've seen that's kind of comical is where a seller says, hey, I don't want to do anything with the business anymore. I'll stay around for 90 days. And you go, great. Well, what incentives have you put in place for the management team and all these wonderful people that have key relationships with the customers? Well, why do they need anything? Right? It's like, whoa, I'm a buyer. You're going to go to Tahiti and I'm stuck with 8 angry people wondering why they got nothing out of the last 15 years of their career. So there is a holistic thought process going into this on how you take care of your entire team if you're planning on hitting the beach or if you're planning on rolling forward.
Completely agree. Completely agree. Now, I'm going to focus again on Mike and Bob for this, which is enhancing transferable value and improving that valuation. And I'm going to give you guys some of the time to talk about it because you're really focused on taking companies with set-asides and moving them into the full and open market. I want to talk about that, and I'd like to hear from you, but I want to leave a little bit of time for those folks who have set-aside companies and are not in the process of bringing them into the full and open market. But Bob and Mike, Bob, why don't you get started first, talking about how would you enhance transferable value to improve the valuation of a company with designations looking to sell?
So first of all, realize whether you're anywhere between 0 and 40 million, everybody has this problem. When I was at 25, 30 million, I had no large, I had like maybe 3 million in large business, but I was looking at the same problem, right? Which customers did I have, and which customers did the company do such stellar work for that it would be possible as the contracts grew to move into the full and open arena. And it's not a mystery that most companies in small business, get their first chops on large business contracts through their GSA schedules, their IT-70 schedules, because you don't have to go out and win an Oasis Pool 1 large unrestricted that you'd never have the quals to win to get a large business award. So I always tell people, look at that GSA schedule, whether it be any of the schedules of what could you move something to large business. But creating value is figuring out that strategy, right? How do I start moving? Again, you don't have to be 100% large business if you want to, join with another company to be bigger or exit or whatever you want to do. It's about how do you show that you have that management maturity to actually move to the next level. For me, it was fighting all along the way. My wife was my CFO until 3 years ago. She's a woman. She was she's part Mohawk Indian. We didn't use any of that. We figured we were going to scrap really hard because my vision was always to get the company up over 300 million because that was just a goal that I had in my brain, right? It used to be 2, but it keeps getting higher. It might be 5 by the end of this year. But as long as I'm having fun. So I think creating value is thinking about how do I go deeper in some service areas or go broader across some clients, right? It's very hard to sell a $5 million business at one customer because it doesn't move anybody's needle. Or how do I start showing that I can win in the full and open? And when we started winning in the full and open, that's when we became interesting as an acquisition target.
Bob, I'm going to stop you there. Michael, your thoughts. And Bob, just correct me if I'm wrong. What I heard you say is if you're a company with designations, in order to increase your valuation, try and get as much into the full and open market as possible. You don't need to make 100% of that transition, but you need to show that you're moving in that direction.
And as long as you have the IT-70, the PSS, or some GSA schedule, If you have a customer that you've done phenomenal work with, you can start bidding things that that customer puts out, large business, on those schedules, because you don't have to go win a giant large business GWAC.
Got it. Michael?
Yeah, so I sort of took a little slightly different angle on this, but I'll start by saying, quoting the great Wayne Gretzky, who always said, "You want to be where the puck's going to be." And I don't think a lot of buyers or sellers do this. Certainly not the smalls, and I didn't. I mean, when we were a small company back in the early 2000s, we didn't think about this either, but I do think there's some value in spending time researching who you think your buyers will be. There's a lot of value in knowing what they want to buy and positioning yourself for an entree to them. I'm not going to say it's easy to do that, but you can poke around. You can talk to investment banking firms that are sent out on missions to find companies. You can make contact with these buyers. But I would encourage everybody to really learn what it is they want to buy, because the closer you are to that, the more value you bring to them, and that ultimately will give you a really successful closing. The other thing I would stress, this isn't really necessarily the improving your valuation prior to sale. This is more about when you start getting in a dialogue or start getting into working deal structures. You really, before you go to market, you really ought to look at your own house and make sure it's clean. I can tell you that I've run into and been a part of deals where buyers have found things that have just brought everything to a screeching halt, and have created bizarre escrows and risk mitigation things. You don't really need that. If you spend some time doing some cleaning up front, look at your operating agreements, run them by your lawyers again. Just make sure that things are clean. That makes the process go a lot smoother, and it doesn't put your valuation at risk. The other thing I would say is, and I run into companies like this quite a bit, and it's, I was there, so I totally get it. Try to get out of the lifestyle model. Buyers aren't really interested in your lifestyle. They're interested in your company, right? They're interested in what you've built and the customers you have and the contracts you have and those types of things. They're not interested that you have 3 cars and, you've got all these things going on the side, whatever. That's part of cleaning house. Get out of that. When you're getting ready to sell, wean yourself off of the lifestyle side of it. I think you'll find it'll go a lot smoother, and you'll be a lot more attractive. The other thing I would say, Cy touched on some of this early on. Make sure you understand the SBA rules. They seem to change. I don't want to say, often, but they do throw these things out there now and again and make tweaks and changes and technical corrections and stuff like that will affect how you are valued. So make sure you understand them, and make sure you understand them in the context of where you are, and you'll be all that more valuable to a seller, or to a buyer. And I think that's all I've got.
Hey, Mike, I think you hit it on the head. There is a gap between buyers and sellers on expectations in the process. So for example, as a small business, you may have 1099s in your portfolio. And this goes back to that unintentionally offensive in the process. You're like, yes, I've got Juan the super engineer. He cares if he's a 1099. He's awesome. He delivers. Look at all this wonderful stuff he's done for the company. And you're excited about that as a seller because it's been part of your business. And everyone in the small business usually has some subs or some 1099s in there. Well, a buyer with a whole team of financial people go, wow, there's 1099s in here. They worked greater than 1,600 hours this year. We need to take whatever the company paid them. We need to go ahead, figure out what the payroll tax is, go back 5 years, run an accrual, and discount or note a risk for the sale. Right? 2 totally different perspectives. Having your books as clean as possible before you go to market is imperative because it gives the buyer confidence. The last thing you want between starting the process of selling and sitting there on the day you're going to close is a surprise. So my advice is get it as clean as possible. Look, nobody wants to, when you're in the process, tell people you're thinking about going to market. As an owner, it used to make me cringe, right? I don't want anyone to know I'm for sale because I'm really not for sale. I'm trying to find the right partner for the next part of my journey, right? And it's really, really, really important that you do this kind of on the down low and with people you trust and get good advice from people who have done it and not necessarily tell you what you want to hear. I hear too many people that go to certain groups where all they do is tell them where they want to hear, and then they try to come to market and they can't, or they have just an absolutely miserable time because someone misset their expectations.
Bob, you're making an excellent, excellent point. And, you know, I'll say this as an M&A advisor, which is one of the first things that we do when we go into a company is essentially do the due diligence that a buyer is going to do. Because if we find the problems, we're friendly folks and we can fix them or figure out if they're not fixable, how are we going to explain them? The worst thing to happen is to get into a due diligence with a buyer who finds those issues. And one of two things will be true. The buyer will say, there's a problem and the seller didn't know about it. That's really bad. Or two, there's a problem and the seller didn't know about, or the seller did know about it and didn't tell us. That's really bad. So either of those scenarios are not a place that you want to be. Now, I do want to turn this over to Cy for a few moments. We've been getting some questions that I think are extremely important, and Cy is the man who can answer these kinds of questions. So one of them is, I think, dealing with what happens when a large company acquires a company with designations. And the question is, do you need to get the approval for that prior to that transaction, or how does that process work? Do you need to get waivers? Cy, you're on mute, but if you wouldn't mind taking that question, that'd be great.
Yeah, so I think there's some confusion out there on this because if you're an 8A company and you have 8A contracts, then yes, or if you're an 8A graduate as well with 8A contracts that you're currently performing, you do have to get a waiver or submit a waiver request to SBA, but you don't have to wait to close in theory, unless if the buyer's willing to take that risk. You could close the deal, and then if SBA rejects the waiver, then yes, the agency is supposed to terminate the 8A contracts. They don't do it all the time. In fact, most of the time I found they don't, even though the law says shall terminate, they still don't. That is not true for any other set aside designation, right? Small business, woman owned, whatever. They don't have to terminate, so they can continue. And most times they do continue. The only caveat to that too is you got to look at your contract. And I know a lot of the contracts have off ramps. So if you cannot recertify within that 30-day window as whatever your designation is, you risk getting off ramped. So even though the law doesn't require it, you still want to look at your contracts and make sure there's something that's not in there that's going to trip and run you off the contract.
Cy, why don't you talk a little bit about the difference between why are most GovCon deals done as stock transactions as opposed to asset deals? You know, in the normal M&A market, buyers always want to do asset transactions whenever they can. And in the GovCon market, that's kind of off the table unless there's unusual circumstances. How is that relevant to what it is you were just talking about?
Yeah, so if you do, it kind of goes back and forth between whether people want to do asset deals or stock deals. If you're doing a stock transaction, right, then there's a few things. One, you got to deal with novations, you don't have to deal with novations if you just buy the stock and don't merge. If you merge, you'd have to do a novation. But if you just do the stock transaction and hold it as a subsidiary, you don't have to worry about a novation. It's much cleaner. You just give a notification of change of ownership, which is just an email, and you're done. The tricky thing is if there's 8A work and you are an 8A, or you have service-able vet work or woman-owned work that's in that company, you cannot hold that as a subsidiary. So you're forced to do a merger, and you're sort of forced to do a novation. And if you've done the merger or acquisition, there's also recertification issues that if you buy the entire company, both you and the buyer and the seller have to recertify on the work you have and the work you're getting. So if you're a small business and you're already large, if you do a stock deal, you don't have to worry about novation, but that's going to trigger your recertification on your legacy work. So all that risk of what's going to happen might happen to you. Whereas if you do the asset deal and you can do a novation, you only recertify on the stuff you're buying, not your own stuff. So you can mitigate risk. So depending on what you're really looking to do, you have to think about how the structure is going to be done and choose accordingly.
Cy, there was an interesting question that just came in that I'd like to ask. There was a PE calling a company that had small business work, and it said that it understood the impact of buying a company with a lot of small business set-asides and planned on being able to mitigate that by not buying directly, but rather financing an individual to buy the company with small business awards. Is that a workable strategy for buyers and sellers? And those in the M&A market, have you seen that? It seems pretty esoteric. I've got a story, but I'll go after you, Cy.
Yeah, so don't tell, what do we have, 130 something people? Don't tell anyone outside of this group. But yeah, in theory, yes, because the recertification rule, which is what everybody's always worried about, right? Because if you do a merger or acquisition, you have to recertify within 30 days, like I said, on your work and theirs. And if you can't recertify, bad things can happen. But the way that rule is written, it says when a concern is acquired by another concern, and concern is defined in the SBA regs as essentially any sort of business. So in theory, if there's an individual who's not a concern, then you're just a human being. You're not putting like LLCs or holding companies or any of that, because then you've blown this whole thing up. It has to be an individual buying a company. Then in theory, you don't trigger recertification. This is sort of interstice in the rule that's, I mean, as soon as it comes up, I can almost guarantee it's going to get plugged. But as of right now, it is an open potential strategy.
Let me tell you about something that we did last year. We had a company that had 65% full and open, but the remaining 35% was still either small business or woman-owned, small business primarily. We wanted, we brought them to market, and one of the parties that was particularly interested was a PE firm. And we actually spoke with a number of PE firms, and I said, you just can't buy them, because if you do an acquisition by the PE firm, first of all, you've got to worry about the affiliation issues, but you're not going to qualify as a small business. What we were able to do is that the limited partners of the PE firm actually invested in the company directly. And it was structured such that we never exceeded the control levels for any one investor. That way, we were able to do a deal that was essentially backed by a PE firm, but truthfully was backed by the independent limited partners who normally give into that PE, give money to that PE firm, and they did the investment directly. There are definitely ways of structuring that. As Cy is saying, you really have very little flexibility when it comes to 8A. And there's also some real restrictions on SDVOSB, because there are some real issues about the veteran must be in 51% control of that company, and all sorts of negative covenants count as undermining that control, as well as rules on how many companies can a single veteran own. So, Cy, could you do, if you were an owner of an SDVOSB and you wanted to buy another SDVOSB, can you keep those two as subsidiaries, or would you have to merge them together?
Yeah, so because you have to have direct ownership to qualify, you can't have an SDVOSB that owns another SDVOSB through their other company, like as a subsidiary. You'd have to have it be sister companies. And in theory, an SDVOSB can have a couple, but when you have maybe 3 or more, you're going to start to get a lot of questions about how you devote your full time, because that's a requirement, to the one. Now, if you have 2 and they're almost identical lines of business, and you can make the argument that anytime I'm out on the road or doing whatever, I'm really working for both of them, then you can make the argument, including with CVE, which is the VA's database. They're kind of a separate thing as of right now, although that's going away in a couple of years. You can make those arguments. So it is possible. The other thing I'll mention on your point about other ways to do it, another thing I've done with PE investments, including in former 8As who still have 8A work, where you'd normally need to do a waiver, if they're willing to buy in at a 49% level, and they're also willing to do it so that the negative covenants for the acquisition is such that it's convertible debt, not necessarily buying straight in and having all these weird covenants. If they're willing to do convertible debt, and at the end of the day, the former 8A owner controls whether that debt is paid, so if they can find the money somewhere else, they can make it work. I've had a few PE firms be willing to do that. So because the value is so high, it's like you're not going to be able to find someone to loan you $7 million or $8 million. This is not going to in these cases. So they got comfortable with it, and because it was debt that was convertible and you still controlled it, the 8A owner, it didn't trigger the waiver request, and I've had sort of verbal agreement with SBA on those things.
Excellent.
Sharon,
Hey, Sharon.
we have a question here. Would a productive joint venture increase a company's appeal in a private exit event, or would it be a distraction?
Excellent question, Ted. Let me take that first, and then I'm going to send it to the rest of the panelists as well. We're working on a company right now. Many of these companies with designations have joint ventures. We're working with one company right now that's getting 85% of its revenue from the joint venture. What that means is that as we're selling that company, we're selling not only the company, our client, but to some extent, the 51% ownership of that joint venture as well, which means that there's another party involved as a decision maker. So it can be more complicated. It kind of depends upon what the relationship is. Michael, do you have any experience in dealing with joint ventures and whether or not that makes the process more complicated for purposes of an acquisition?
Unfortunately, I don't. I have some experience with a joint venture, but it didn't have anything to do with a sale. It was just something that we did, many, many years ago, back in the 90s.
Not a problem. Bob,
yeah,
how about you?
So Sharon, first, I just want to say to the entrepreneurs out there that the discussion we just had about innovations and strategies to do equity and everything else ticked in my brain that if you are thinking about bringing your company to market, you need to be ready to spend hundreds of thousands of dollars in good advice because it's very complex. We didn't even talk about F-type reorgs and all the tax implications of doing this. So know that if you think you're going to bring your company to market and sell it for millions of dollars and spend 10K on like a guy you met in a lobby, that's not going to work because these issues get very complex very quickly. And both on the legal side and on the advisory side, there are people who specialize in whether it be, F-type reorgs, whether it be SBA novations, whether it be consent clauses. So there's a lot there. It's my only offering I was going to say. And be ready to spend your way into the process because if you don't, you'll end up with a bad event. That was my 2 cents here as I was listening to you guys because that's just now on the JV thing, Sharon. That again comes down to the personality of the owner and the buyer. Me personally, I've evaluated probably 10 or 15 companies that have JVs. It depends on whether or not the JV is real and what the partnership looks like. There's management documents that we need to review to make sure what happens if an event triggers, who wins at the end of the day. Are there any clauses where another partner takes the role of the management of the JV? Well, who's my new best friend after I cut a check? That's what you're thinking as a buyer, right? I've also seen companies that have gotten so distracted in JVs that they forget that they have a core company and there's no prime revenue just for them. So me personally as a buyer, I'm not a fan of JVs. What I look for is companies that have said, okay, I'm going to sweat my way through this thing and figure out how to use my great delivery, my good client relationships to keep building past performance under my company's name. But that's me. I have peers that will say, hey, if they've got 3 or 4 JVs, that's great, right? No problem. We'll take the revenue. We'll just discount it because God knows what will happen to it down the road. But that's my 2 cents on it. As a owner selling, I never did it. And as a buyer, I try to avoid it.
Excellent, Bob. Cy, I'm going to throw this to you. You've structured joint ventures. You have sold parts of joint ventures. How do you think that buyers look at joint ventures?
I think I would agree with what everyone said. The only other piece I'd put on it, probably because I have like the the legal view of things, is if you are sitting there and you're in that weird middle market space where you haven't been maybe super successful yet, but you're big enough that you're not a small business and you have a number of mentor protege agreements or something, and you are sitting there with a lot of 49% ownership interests in joint ventures, there is some risk to that. But at the same time, I think it's important to note that because you're in mentor protege relationships in this example, that when you're acquired, you don't necessarily have to recertify on those JVs, or if you do, it's irrelevant. So a big company coming in and buying you isn't going to blow up all those JVs. Whereas if you are the managing member who's like an 8A or a woman owner or whatever, and you're the managing member of all these JVs and you are acquired, that will trigger recertification across all those JVs. And then all that stuff about, am I going to lose the work? Am I getting off ramped? All that applies. So if you're in that weird space and maybe you want to get out, or you're thinking about selling, or you need a place to grow, but leave yourself that space to potentially sell, I think having these ownerships in these JVs that might be a lot of small business work isn't the worst thing in the world, because if you're bought, it's not going to blow them up.
Excellent points. I see that it's now 5:31. So I think that that was the time period for this panel.
Hello, folks. How we doing? All right. I'm Bob Lofeld. Nice to meet you guys. Anybody got any interesting questions?
Well,
I
Bob,
don't know what to ask because I'll tell you anything.
well, Bob, that was a very good presentation. Thank you so much for explaining everything. Next time, I just want you to add CPAs helped you with the tax issues.
Yeah, so no, I tell you what, some people go into this process thinking it's going to be cheap and fast, and it's not.
Yep.
My tax guy, I went through an F-type reorg, which is an accountant, is a major restructuring of the company because it had tax advantage. As an entrepreneur, F-type org reorg, you want to hold it? Let's go build something in the cloud, or do some offensive cyber work, something exciting. So it takes people that get that exciting about accounting, legal, and advisory as I do about IT. It's spot on. And my accountants were phenomenal.
Oh, that's the right thing. I think you said the right thing, is if you hire the right people, or what did one guy say, be the dumbest guy in the room, it really helps take care of your business.
And the other thing a lot of entrepreneurs don't do that I did is I read everything. I read and took questions on every single document in my transaction, so I understood what I signed up for.
Wow.
Which a lot of people don't, and they kind of take the highlights, and all the devil's in the details. So
That is a statement a lot of us use all the time. No, that's awesome.
What other questions?
We've got 58 people. Somebody should be talking.
Yeah. Who else has got a question?
One thing on that point that you were mentioning, I just have a quick story. I do a lot of M&A transactions, obviously, and I've seen really bad things happen when people look at like the top line sheets. I have one where I didn't do the transaction. I came in afterwards to clean it up. And what happened is they didn't want to hire anybody, and they hired a CPA who was very good. I know the guy, very good CPA. They hired him for 24 hours to look at some stuff. He flagged like 30, 40 issues, and then they ignored it and they closed. 6 months later, the bank who financed the transaction calls me and says, hey, these guys are losing $150,000 a month on this transaction. They're going to be insolvent anytime. And we looked at the documents, and I talked to the CPA, brought him back in, and the company, the seller, had put together all the documents to show 8% gross profit, and they had a 30% G&A, and like nobody caught that.
Yeah.
Wow.
So I will tell you that SB Liftoff was not involved in that deal. You would have caught that, man.
No, they were not.
Hey, side to your
I'll
point.
say I didn't finance it either.
There you go, Doug.
Hey, side to that
Hi,
point.
Doug Brown.
To that point, Si, I tell all entrepreneurs, one of the things you should do is ask at least 5 or 6 people who have done deals who they used for accounting, legal, any other strategy advice, and interview those people. Because there's a lot of great people, including yourself, in the market. Sometimes what breaks or makes who they select is who they click with. If you don't personally click with your attorney, your experience will be beyond a root canal. In my opinion, both buying and selling is a root canal. You're glad when it's done, you know the drilling has to happen, but it's pain, right? And there's not enough anesthesia to make it go away. So sometimes it's who do you click with? Because you're going to spend a lot of time with those people, and they're going to tell you things you don't like. They're going to upset you because the world doesn't work the way an entrepreneur wants to work, right? And the third is they have to be in a position where they want to learn, because the attorney, the CPA are going to teach them things that have nothing to do with what they've done the last decade building a company.
Bob, if I could ask a question. You said you were actively backed by a private equity company, so you're a platform, and you're a hybrid, if you will, and you're actively looking to make acquisitions. And in your presentation, you said you had looked at many deals. Given the heated conditions of the market and the fact that you're backed by a PE company, which means you can bid aggressively, what would you consider are the current market multiples based on EBITDA, multiple of EBITDA, for a government contractor? And to address this market, let's say they are 25 million in revenues, about 50% set aside. What are the market multiples right there? You know, traditionally they've been 3 to 5. Are they 5 to 7? Are they up towards 7 or 8? In other words, hard tax. What are the market multiples now for a lower middle market government contractor that has significant business that is set aside? Can you give us a hard number?
Yeah, Mike, I think it's a great question. So first of all, I characterize the market right now as the Wild Wild West. There's a lot of people popping up behind rocks with money that are getting into the game that you're like, wow, I didn't even know they would bid for this kind of asset. That is pushing prices up. I agree with you. If you had 50% small business even 6 years ago, 3 to 5. If you go to Super 8A, 3 to 5. If you're trying to get into the PE game, you know, and this is a scale. The more large business you have, the more multiple goes up. You know, 6 to 8 is the norm, and all day long. If you're you know over 50% of small or large business, and you show that you're pushing that way, if you sit down and your pipeline shows a bunch of set-aside stuff, they'll know that you weren't ready to come to market. If you also have a pipeline that shows everything you're going to chase is 500 million and you're a $30 million company, they're going to know you really don't know what you're doing on the transition. So that competence factor also drives the multiple after IOI, which is why that management presentation is so important. I have seen in the small things go north of 8 for very specialized capabilities in specialized market. Intel's always going to get a premium. Cyber's hot right now. Digital transformation's hot right now. But it's high. I mean, it's a great time to exit.
So if you're bidding 5 to 7, you might be low. You're saying 6 to 8.
No, what I'm saying is it depends on the deal in the slide, right?
Sure.
Yeah, but I've seen some crazy stuff. I mean, we've been outbid on stuff. I'll tell you straight up, because for me, it's more about there's this weird what I call number of what number does the owner need to have to square away their life and feel good about their accomplishments in building their company. Anything on top of that is gravy, right? I'm pretty pragmatic when I look at that stuff. For me, I will actually pay a higher multiple for a better fit with the management team than I will with one where I think I got a 50% flight risk. So there are subjective things outside of the book and the numbers that come to play in the bidding process.
I think there's a lot of things that go into the book and the numbers, such as what are the margins of this company? Is it a T&M company that's got 4 to 6% margins? Or does this have firm fixed price contracts and they're sitting there with 18% net margins.
Yeah.
So there's a lot of factors, what's the strength of the past performance? Do they have good CPARs? Are they in one of the hot areas, healthcare, IT, or cyber, or cloud, or whatever it might be?
Sure.
Hey,
Great
Sharon.
point. You're spot on. Like, if a company has 50% small business that they're turning 25% profit on, and they're full and opens at 3.5, the buyer will go, well, geez, what's the future look like, right? Clearly, they were getting set aside sole source rates, and when they actually have to compete with 5 or 7 people, the margins came way down. Or what I like is we used to have 15 people on overhead, and now we have 3, so our profitability went up. Come buy us, right? You see a lot of interesting stuff out there. It's all about being a great business when you get to market, and that's what moves the multiple.
Hey, Sharon, can I throw another question that I think our panelists will have some interesting perspective on? It's an angle that we didn't hit. And that is, how do you look at, from your perspectives, prime versus sub contracts substantially on the base? And then I'd like to hear from Cy also, because I think there are some different structuring techniques that could be used that may benefit subcontracts.
Absolutely. So let's talk about that. At the highest level, a prime contract is more valuable than a subcontract. We're just going to start there. Having said that, you've got to look at, why are you a sub? Are you a sub because you are gaining past performance, you're getting revenue, you're generating profits? That's terrific, but it doesn't necessarily translate into value in a sale. It also depends upon what your relationship is with the prime contractor. If the prime contractor is one of the big guys who will cut out a sub just because it's Tuesday, then there's not a lot of security that when somebody buys your company, that subcontract's going to continue.
Yeah.
On the other hand, if you are a sub because you've been, let's call it a designated sub, the government has said, we want these people to be on this contract. They don't need to be the prime, but they need to be a part of it. Well, you've got far more protection. So a lot of it depends upon, why are you the sub and what does that look like? We talked about early on the advantages of doing M&A. M&A, and many of the people that we talk to, is a way of skipping the first 2 to 5 years of misery of owning a GovCon company. The first couple of years where you're taking subcontracts, where you're taking whatever work you can get, so you can develop some past performance, get some revenue, get on the books. Well, I'm definitely seeing more people now saying, life's short. I'd like to buy a small company that has prime contracts that, even if they're set asides, I'm not going to pay as much as if they were full and open, but that company saves me 5 years of my life. So the subcontracts can get you there. I think that the prime contracts are more valuable, particularly in the circumstance where somebody wants to use you as a stepping stone towards further growth.
Hey, Sharon.
Yeah.
A question for you, because I have a personal bias. I don't mind sub if it's to a mid-tier or a small business, because I view that as the propensity of me getting cut is fairly low, because they're probably going to have a good relationship with someone who can make sure we don't get cut. I get very nervous when I see a lot of subbing to the publicly traded companies, because even me as a mid-tier, they cut me, right? So what are they going to do to the little people? Because their incentives are all around increasing DL. So from a valuation perspective, I like to see more subbing to either another small or a mid-tier. Then we have 40% of our business is sub to this billion-dollar behemoth. Right?
Completely agree. It's been, when we're doing it, we do an analysis of what's the relationship between the sub and the prime. There was one circumstance where it looked like it was a mid-tier that was basically working with a smaller company. We were selling the smaller company. But it turned out that the head of the mid-tier company and my company had gone to college together. They'd known each other for 25 years. I felt pretty confident that that relationship was going to be solid, and I didn't have to worry about that being, that was something that I could sell to a buyer. On the other hand, and no insult intended, if it's, let's say, Booz Allen, if they've got the opportunity to bring the work in-house, that would be their orientation. So it really depends upon who your relationship was with And what is the basis of that relationship? Did they simply need you in order to get that work done? Or is there some type of personal tie there that makes a big difference? Sai, what do you find about that?
Yeah, that and the fact that if you're a small business, right, and you're looking to sell, and they're taking small business credit for you on the small business subcontracting plan, that's also going to increase the risk that you're going to get dumped.
Yep.
You can't do that. And also, or even worse, if you're similarly situated, so you're doing part of the 51% of it's a services contract, that's also going to really increase the risk of a problem because your small business status is directly relevant. Whereas if you're just like a mid-tier or something like that, and maybe you're working with a small business and they need you to get that work done, then I think that's relatively safe revenue. And on top of that, your recertification, or if they make you do it, it won't even be relevant. You won't even have to do it, frankly, unless there's some weird thing in your subcontract. But even if you did have to recertify, it wouldn't matter because your status isn't relevant to those dollars, unlike prime work where your status might matter. So it's unfortunately, these things are all about risk balancing, right? And whether or not that benefit of not having it go away versus it being a subcontract is worth more, and it can be.
And Sai, isn't it possible that that doing a transaction as an asset deal or an novation would be more viable with subcontracts?
Yeah, because in that case, unless I've seen some of the really big guys, the publicly traded ones, actually have novation. They even call it that, which I think is amusing, but they'll have like novation terminology in the subcontracts. But most of the time, you're going to just look and say, okay, what's the anti-assignment provision? Does it say notice? Does it say consent? And if you have a lot of stuff that just says notice, then yeah, you won't have to worry about any of that stuff.
And Sai, that's a great point, because usually when this comes to bear is about 3 years after you sign the subcontract. And I didn't even think about consent and novation clauses until I was getting my own house in order. I'm like, wow, we signed this 3 years ago. That's some really sucky language. Talk to our friend over there and see if we can amend it, because this is cruising for a quick discount. And you don't think about that as consent clauses and that when you're running a business and serving customers.
You guys are also talking about this from the seller's perspective. From the buyer's perspective, it's absolutely, as Sai said, a risk factor.
Yeah, I discount it.
If I buy this company and it's got all the sub work, what comfort do I have that in 6 months or a year from now it's not going to be cut? Do I then want to start putting earnouts on the fact that it doesn't? And you as a seller is begin to say, wait a minute, my money is going to depend upon whether or not the prime cuts these people who may or may not be good at doing their job. And that's going to, so it's definitely adds an element of risk to it that becomes more challenging.
And I hate earnouts.
Hey guys, I apologize for jumping in. Just want to let everybody know we have 3 minutes.
I'm going to respond to Bob's comment about earnouts, because earnouts in a traditional form truly are terrible. I mean, it's basically a way of, it's the full litigation act. However, earnouts structured properly, in my view, should be a seller has planted seeds in the ground, but they haven't yet sprouted. And a buyer doesn't want to pay for anything that hasn't happened yet. So it's a way, an earnout properly structured should be that, hey, listen, we took this step. We think that this is going to be great. We're willing as a seller to take some risk that it actually happens. And I say to the buyer, you should be happy to pay this, because it only means that something came through that wasn't there at the time of the sale. So doing an earnout along those lines makes a little bit more sense than the traditional.
And Sharon, if it's a proposal that's already in the bucket that they're waiting on a win notice, I could probably get behind that, right? You win it or you lose it. I get it, a binary number. But if you're going down the earnout path and you're a seller, you need to make sure the earnout is big enough to cover your legal fees to fight it. If it is literally not very clear. If it's, we submitted 3 proposals 30 days ago, and if we win them, here's the accretive value to the company, we want something for it, maybe. What I have seen in some of my peers is you get into an earnout and then the focus is making whatever occurred in the earnout happen versus creating new value in the company. So I think I agree that if it's really that simple, I can probably get behind it, but I'm not a huge fan just because I've seen it become the focus of the new management team coming in. We got to get those earnouts, let's keep doing this versus let's create value for the new company.
Hey, guys, I hate to do this, particularly with this spectacular panel, but thank you, panel, very much. Okay, thank you, guys. That was fantastic. And just to everybody, just to let you know, everyone will get a copy of the attendee list. You will get a survey, and a recording of the session will be available. I think that takes 2 or 3 weeks to have that available if you want to replay or share. So thank you guys very much for joining. Thanks again to our speakers. Happy St. Patrick's Day. I don't think a single person brought a green drink.